right here. I just want to give you a few reminders. First of all, we are broadcasting live to Facebook and YouTube. So if you'd like to see our program as well as hear it, you can go to the 360 Info Network Facebook page. You can also go to my personal Facebook page, and you can go directly to YouTube and go to my YouTube channel, and you'll be able to get this program. With that said, you can also make comments as the show is in progress. And in future editions, we'll actually give you the opportunity to come on live with us on 360 Info Network. So with that, I'd like to welcome you to the show. Also, do me a favor. When you go to my YouTube channel, please like and subscribe. It really helps me at some point to be able to monetize the content that I'm providing for you. Right now, it's a labor of love, but if you give me a like and you subscribe to my channel, it will help me out tremendously. So with that said, welcome to 360 Info Network. Brother Hamtonio cannot be with us today, but he has invited two fantastic individuals to be with us on the program today. And they are both experts in the fields that they are involved in. We have Mr. Don Durrah, who is a real estate professional, and he's going to give us some insight on real estate today. And we also have Mr. James Oliver, who is a tax professional. He's an accountant, and he's going to give us some ins and outs. This is the end of the year. You know, as January begins, you're going to start getting those forms in the mail. And some of those of you who anticipate having hefty refunds, you're going to be lined up at his door so that you can get your money as soon as you can. So Don is going to give you some information on what you should do to prepare for the upcoming tax season and tell us about some of the changes or some of the things that are still the same. So with that, I'd like to welcome Donald Durrah and James Oliver to 360 Info Network. How are you guys doing today?
Doing very well. Thank you for asking.
All right. I'm doing fine.
All right. Well, I can see that Don is serious because he's got a whole lot of ammunition. He actually wanted to blur the background, but I'm like, no, let folks see that because they know they can see that you are about business. So if you're in the market for a home or you want to sell, I think maybe he is the person to go to. So why don't we start with Don? Don, tell us about your company, what you're doing with real estate, and we can get into some of the suggestions that we'll make to our guests.
Well, I'm in real estate sales. Durrah 2 Real Estate. I sell real estate and manage. And but most important today is the tax, the reappraisal of taxes on your property. This coming up January 1st, and you have from January 1st to March 31st to appeal what they say your property is worth. Many times in this reappraisal, of course, values in Cleveland and Cuyahoga County are going up. Everything's going up. But that does not necessarily mean that your property is going up. Sometimes you get swept along in the process, and when the house down the street, the house next door, the house around the corner, that price goes up, it sweeps yours to going up to the same price, and your property may not be worth the same as theirs. Not that it's a lot different, but it may not be worth the same.
So when you go into the hearings, and I've been in a couple of those hearings, as a matter of fact, but when you go into the hearings, how should you prepare for it?
Well, first of all, when you go into the hearing, when you appeal, you send your application in for that you are appealing, putting them on notice that you are appealing. Then they'll give you a date, but you should have an appraisal. You can't go in there woofing and talking about, I know, and my house is not as good as that one of my. You can't do that. You have to have proof, and proof positive from a third party who is no interest in your property. Now, once that happens, then they look at that a little stronger than you just going in there saying, I believe my property is worth less.
Okay. So, just to use my own situation as an example, I live in a subdivision that was built 31 years ago. All of the houses are pretty much the same. Some are 3 bedrooms, some are 4 bedrooms, but basically, we all got in close to the same entry point. We have varying degrees of land, so some might have larger lots, some might have smaller lots. But when I went on to the county website to look at the property values, I saw a wide range of differences. And, I understand one of the factors in the value of the house might be things that need to be done. For instance, if you have a house that's 30 years old and it's got a 30-year roof on it, it's not going to be as valuable as a house that has a new roof on it. So, how do you arrive as an appraiser at a value of a house when you take into consideration all of the things that I just mentioned?
Well, one of the things you look at, they're the same type of property, single family versus a two family. Sometimes you'll find two families and single families in the same area. But we look at square footage. How close is your property in square footage? How many bathrooms? How many bedrooms? How many, if there's a two-car garage or a single-car garage? And the lot size, you mentioned that. And then the community that it's in. And you know as well as I, and sometimes in Cleveland, you can live on one side of a big highway or main street, and someone else lives on the other side, and the prices are different. Euclid Avenue, St. Clair, Superior, Kinsman, Union. One side of Kinsman may be worth more than the north side and the south side. In every area, they have a sections that this main street divides important values, important things about even the school systems. All of them are the same Cleveland public schools, but you go to a certain school system if you're over here rather than over there.
Okay. Yeah, and just again to illustrate the point, our subdivision, all of the homes were built around the same time in 1992. But in the periphery of our subdivision, the homes are much older. So when you look at the property values, you also see kind of a disparity in terms of our houses versus the other houses. These houses actually started out at 79,000. That was the base price for the model. And then some houses had like 4 bedrooms. Some of us were able to install a fireplace. Some of us got a brick veneer on the front of the house. But again, over the years, I have looked at property values, and I've seen the value of my house go up to as much as 130,000 from 79,000. And then I've seen it go down again. But I also know that I have appealed a couple of times, and I was successful in getting my property taxes lowered. Let's bring James into the conversation right now, and just talk about what is the basis for the tax that they apply to different properties, if you can tell us.
Well, normally the basis is several different things. It's one, the neighborhood, what city that you live in, also the house itself, and in terms of, as Don was saying, the makeup of the house, if it's a 2 bedroom, 3 bedroom, how large it is. So the physical makeup of the house. Those are the two biggest things that make up property taxes. Shaker Heights has been um, in terms of square footage, probably the highest in the state in terms of per square foot what you pay for property taxes. And of course, Cleveland is obviously a little bit lower in that rank. But that's kind of how they and the property taxes that you see from the county doesn't always really reflect the value of the house. So that's it's just an estimate or educated guess. I'm not sure if Don would agree with that, but that's just, my perspective on that.
What's your perspective, Don?
Yeah, well, he's right. It's a guess because when in this reappraisal, they don't go around every house. They take a model. They may take one house around the corner and say, okay, that house sold last year for 105,000. So every house that looks like that house, let's say it's worth 105,000 too. So your house may look like it, but the conditions may be different. The square footage may be different. You have a one-car garage. They have a two-car garage. They have a finished basement. And what's happening today is people are going in and rehabbing these houses and completely doing them over. And they're getting 140,000 where it should be 90. Now they want to say every house in this area is worth 140. But see, every house didn't get rehab.
Okay. So with that scenario, we're seeing some inequity in the taxation system because some people are being penalized because they haven't done upgrades on their house and their house isn't actually worth as much as the other house, but they're being taxed at the same rate.
Exactly.
Correct.
Yes. Okay. All right. So you mentioned getting an appraisal as one of the things that you would want to do in the hearing that when you go to appeal your taxes. Are there any other things that you think are key to your success in getting your rates adjusted?
Well, one thing that's very good, if you bought the house and you can show that you purchased the house, let's say the area that you're working in is 110,000, but you could show very clearly, I paid 79,000 for this house. Well, that's one thing you could do. Say, hey, look, here's my paperwork. I paid 79,000. I want the value to go down to 79,000.
Mm-hmm.
But by the same token, if you paid 150,000 and the medium price in that area is 110, you can't get it down to 110 because the fact is you paid 150.
Okay. All right. Another thing is coming into mind. You wanted to say something, James?
No, I'm fine. Okay.
Okay. The other thing that just came to my mind is the idea of a homestead exemption. Perhaps you can explain that, Donald?
Yes. Well, the homestead exemption comes if I think 62 years old. Unlike years before, at this time the homestead exemption has a income level on it. If you make too much money, you can't get the homestead. Now, once you have a value on your house, you still have to set the value. Then the homestead comes off of that value. If you lower that value, then your homestead brings it down even further. If that value is high and you figure my house is not worth that, you want to bring that value down, and then the homestead kicks in after the value comes down.
Okay. So now you get my attention because I'm over 62. What are the income requirements?
They're very low.
Very, very low. So
Very
you,
low.
Vince, forget about it.
You're saying fresh dress look like $1 million. You possibly could not have low enough income to
Right.
qualify, but
Right.
who knows?
And
But
the funny part about that is that people with the low incomes don't have the houses. They can't afford to buy a house because their income is so low. And so they knocked out a lot of people. I have homestead, but I got it years ago. Years ago, and there was no income on it at that point. So I'm kind of grandfathered in.
yeah, your grandfathered in. Now, the other side of the coin is there ever a situation where you want your property value to be higher?
When it's time to sell.
Yeah, and see, this means nothing about taxes. See, you can have a value for tax purposes of 110,000, but when it's time to sell, you may say, hey, look, I want 150. I don't care what that says. I want 150. If you want to buy my house, you're going to pay 150, and that's what you sell it for. So your house is not sold based on the county tax duplicate.
Okay. That's good to know. Jane, do you want to add anything to that idea of taxation on your property? Can you think of things that people could do to perhaps reduce their tax exposure based on the value?
Well, okay, we're talking about two different things here a little bit. If you're talking about in terms of if you sell your property, the tax code basically says, and at this point it could change anytime, but as it stands for today, someone who buys their house and then sells it, if it's a single person, the first $250,000 of profit is tax free, and that's based on what the cost that you paid for the house and any improvement. So let's say you paid $150,000 for your house, you live in it for 20 years, but in that time you had maybe $50,000 worth of improvement. You know, new roof, new driveway, cement driveway. You might have added, you know, another room to the house, and so when you now add the what you paid for it plus your improvements, you still have another $250,000 of profit before your tax done. For a married couple, it's $500,000. So in the greater Cleveland area, that's not a bad idea or not a bad deal in terms of selling your house, get as much as you can for it, and pay very, very little taxes in terms of the profits. Now, with respect to, you know, in terms of just property taxes, that's another issue. But as Don was saying, the real value of your house is what someone's willing to pay for it. If the property values are, if they're saying it's worth 110, but you feel your house is worth 150, and someone's willing to pay you 150, then your house is worth 150,000. But if no one's willing to pay you for that 150,000, and they say the most that we're going to pay for this house, if you kept it on the market for over a year, that's 125,000, then and you agree to that, then your house is only worth 125,000, not the 150,000 that you thought.
Right. It always comes down to what someone is willing to pay you for your property.
Correct.
When it comes to the true value of the home.
Yes.
Okay.
Absolutely.
So let's shift gears and talk about taxes, James. We're coming into the season. What should we be apprised of as we go from 2023 to 2024?
Okay, one of the big things that people are concerned about is this receiving, you know, for an example, hairdressers, barbershops, nail techs, people who are in that business tend to, instead of getting cash from their customers, they will get either a Cash App or Zelle. And so, you know, IRS is always, always looking for people who are not disclosing, who are not sharing what their actual income is. And so they try to set up fences or rules so they can capture some of these things. And so one of the things is, you know, for an example, this credit cards, people using credit cards. And so they have forced the banks to say that if someone has credit card income of $600 or more, then they will issue that person a 1099-K, and also, of course, a copy goes to the IRS, so that that person now has to make sure that they report all their credit card sales, because they also know that IRS has a copy of that same report. In that same spirit, what they're trying to do is for people who are using Cash App, instead of saying pay me cash, just Cash App my account. And so IRS once again wants to capture the amount of Cash Apps that people are using. And so, and they're still trying to, they were going to do it last year, they were going to do it this year coming up, and still they haven't quite formulated right. And so they've put it off. And so basically but the law basically says is if you have over $600 in Cash App income, then you are supposed to report that to the IRS. And like I said, right now, they're going to kind of hold off to that. If you have, right now, what they're saying is that if you have $20,000 and let's say at least 200 transactions, then you definitely will get a 1099-K. See, part of the problem with this is this. Let's say, for an example, let's say you work in an office and you work with a staff of maybe 10 to 15 people. Let's say you go to Slyman's and say, hey, I'm going to go to Slyman's and does anybody want anything from Slimans? And let's say everyone in the office wants a sandwich from Slimans. And so instead of giving you cash, they cash app you. And so now what happens is that, and let's say you do that a few times a year. Well, wouldn't be difficult if in capturing that you could have $1,000 in cash up for reimbursement of lunches that you provided for your colleagues. Well, obviously, the IRS doesn't know that this is just a reimbursement for lunch. All they're seeing is that you have a 1099-K that says $1,200 for the year, and so IRS wants you to report that as income. And so what you have to do at that point is to say, although I received this kind of money, it was not for any income. I was not working. It was just reimbursement. So now you have to explain that and so that's part of the problem with this 1099-K, because there are people, let's say, for example, a parent gives their child in college, maybe instead of putting it in their checking account, they cash app them, $1,000 because they need that. Well, that wasn't income. That was just something that the parents gave them so they could obviously exist and take care of their bills in school. So that's part of the problem with this whole thing, that all the money that people are receiving through Cash App is not income. And so IRS is having a hard time to say, okay. And so that's why they've put it off for another year, to see if they could try to perfect this a little bit more. So I think that's one of the big things that people are talking about. Another thing that people should be concerned about is cryptocurrency. In this age, once again, people are using cryptocurrency. People are receiving money for cryptocurrency. People are also receiving cryptocurrency as income. And so one of the things that IRS wants to do is to capture people who are receiving cryptocurrency as income or are using their stock. You buy Bitcoin at one price and you sell it at another price. Well, that is a taxable event. And so what happens is that IRS, once again, wants to say, hey, we want you to claim that on your tax return. And if you don't, then we will send you a notice saying, hey, we noticed that you had $2,000, $3,000, or $4,000 in selling cryptocurrency. So those are one of the things that's another thing that people just need to be aware of. And in fact, on the tax returns, if you haven't really noticed, in the last, let's say, 3 years, and this year will be another thing, they'll ask the question, do you have any involvement with cryptocurrency? If you say no, and you do, and you get caught, well, now you've lied to the federal government. You've purged yourself. And so that could mean jail time, could mean a big fine. So if you are involved with cryptocurrency, just check the box and say yes. It does not mean you've done anything wrong. Doesn't mean that you had any income. But it's better to say yes than to say no and to find out later that you have been involved with it, and now you are kind of caught yourself in the middle. So I want to make sure people are cautious about that in terms of coming into this tax year. Some of the things that, in terms of the new things that for this year, along with and one other thing that we kind of talked about that people do not have to worry about at this point is called full disclosures of LLCs. And so what Congress wants to do is they want to make sure that they have information on every LLC in the country. Now that's a huge task, but this is, once again, IRS is trying to, part of the thing is that, we have this big debt. We have, when we had we had the, what was that called? The virus. We gave a lot of money away during the virus to people for different things. And so along with some other things, the federal government is in a lot of debt. So they're looking for ways to get themselves out of this debt. And anyway, one of the things that the Congress has charged the Internal Revenue Service is that they're saying that there are many, many people who do not claim all the income that they make. And so they're charging IRS to say, find this income, whatever way you need to do, which is why they start making requirements. If you notice, if you have a bank account, you have interest more than $10, you're supposed to report that. You're supposed to report, if you have stocks and bonds and you buy and sell those, you get a reporting of that. You get a W-2. If you have, let's say, for an example, if you're an independent contractor and you pay an independent contractor more than $600, one of the things you're supposed to do, let's say you have a roofer who puts a new roof on, And let's say he's a individual, not a company. And let's say you paid him $1,200. Well, in theory, if you pay that roof for $1,200, you're supposed to get his social security number, you're supposed to get his address, and you're supposed to issue him a 1099 saying this is what you paid him. Because if you're going to try to write that off, and let's say if it's rental property, well, as a rental property, in order to write that off, and if you get challenged by the IRS, and IRS says, okay, well, you paid this $1,200 to this individual for a new roof. Did you give them a 1099? If you say no, they will not allow the deduction. So that's a way to force the hand of people who are paying other people to report their income. And once again, I said IRS is always looking for ways to make sure people are reporting all the income they receive during the year. They'll never get everybody, but they'll keep trying to get as many people as they can in that bucket. So just keep some of those things in mind. Some of the things that have changed in terms of people who use their cars for business. The mileage rate has changed for 2024. It's gone up to 67 cents. In 2023, it's $65. I'm sorry, 65.5%. Now, keep in mind that if you use your car for your business, it does not mean that you're going back and forth to work is not a tax deduction. Even if, say, you live in Cleveland and you work in Akron, or if you live in Cleveland and you work in Youngstown, going back and forth to work as an employee is not a tax deduction. No matter how far it is, it's still, whether you're going from next door or 150 miles away. But if you are using your car for business, you're self-employed and you use your car for business, then you can write off. There's two ways to write off your car. One is mileage, as I just talked about. The other way is what's called actual expenses. And that includes gasoline, insurance, repairs, tires. And in the sense, if you're going to use actuals, you still will need to know your mileage, because IRS knows that no one, basically, if they have only one car, uses their car 100% for business. So now you have to divide how much do I use my car for business versus how much I use my car for personal. And so it's a matter of keeping a lot of receipts, and that's why mileage just tends to be easier for people than to keeping all the gas receipts, keeping all the insurance receipts, keeping all the repairs. But that is available to people, and sometimes keeping those receipts, you will find it maybe more substantial for actual expenses, because you can also depreciate your car as well. So those are some of the things that you can think about. Home energy is coming back. Home energy has come and gone. IRS used to have this rule that said that the most you can write off on your house, let's say by installing windows and doors and solar panels, was $500. Well, they finally took the lid off that $500 limit, because that limit was a lifetime. So in other words, if you spent $500 prior to 2022, you could not spend more than $500. And so IRS realized how crazy that was, and they eliminated that limit. So now you can go up to $1,200 a year, and there's no limits. And once again, it's for windows, it's for doors, it could be for insulation, it could be a new roof, it could be for heat pump, it could be for a furnace. But in order to get this deduction, you have to get something from the manufacturer that says that these windows or this item, this door qualifies for the energy credit. If you don't get something from the manufacturer that says that, then you won't be able to take it off. Of course, if you have any questions, you can ask and jump in at any point in time. But that's something, as I said, they're bringing that back. They are giving credits for electric cars, and once again, you have to get something from the manufacturer, because there's very, very strict rules. You can get up to $7,500 in tax credits for an electric car, but there's very, very strict rules in terms of where it was made, the parts, the battery. And so unless you get something from the manufacturer, then you won't be able to just buy a new car, an electric car, and say I can automatically get it, unless you get something from the manufacturer. The other thing the IRS is thinking about doing is maybe giving you the credit up front and reduce the sales price. And so there's two ways of getting that. One is buying the car and taking the credit, and two is letting the manufacturer or the sales dealership get the credit, and they will reduce your sales price for that amount. So that's another thing that's new for this year. Um, we talked about one thing I also, as the end of the year comes, it's some small things that you may want to consider, and I'm also once again appealing to the business owner. January 15th is the due date for estimated taxes, and so if you're a self-employed person or an LLC and you had income, then you need to pay estimated taxes. And if you haven't paid all year, I would suggest highly to make a large payment for this last quarter. IRS does not like self-employed people, whether you're, no matter what you do, if you're a trucker, if you're a construction person, to have that money saved up when you get your taxes done and pay it at the tax time. You will be penalized even if you pay the whole bill at April 15th. If you did not do estimated taxes along the way, you will be taxed and penalized for not making estimated payments. However, if you made this big payment in December, then the penalty will be reduced greatly and the interest will be reduced greatly because you did make some kind of effort. So I would encourage those who are self-employed to have their payments in by January 15th. If you know even if you don't have, just pay something. Please pay something. That will go a long ways in terms of that, your tax liability. So another question may be, okay, what kind of income do I need to have before I start paying taxes? And so for 2023, your income, if you're a single person, and you is 13,000. Let me get over here for a quick second to get these numbers exact. For 2023, if your income is under $13,850, then you don't have to pay any taxes. You don't even have to file taxes if unless you're just filing your taxes to get a refund from withholdings. But if your income as a wage earner is under $13,850, then you do not have to file your taxes. If you're head of household, that number is, and under 65, 15,000. Let me look at this here real quickly. It's $15,350. For a married couple, the number is $30,700. And so if your income, once again, is under that amount, you really don't even have to file taxes. However, let's say, for an example, you work someplace part-time at Walmart and they withheld taxes. Obviously, you want to file to get back your refund. So that's something that you may want to consider, depending on your financial situation. So, questions?
I have a few questions.
Sure.
But we've also been joined by Brother Antonio, so we'd like to welcome him to the broadcast and remind everyone that you are listening to and watching 360 Info Network on AM 1490 WERE. We're also broadcasting live to Facebook and YouTube. You can find us at the 360 Info Network Facebook page. You can also find us at YouTube at my Facebook page and my YouTube channel. So continue to watch. If you have questions, you can actually ask a question by visiting any of those websites and typing your question in. We'll get a notification about your question, and if we can, we'll go ahead and answer that question for you. And as always, please like and subscribe to the YouTube channel and the Facebook pages when you go in. Welcome, Brother Antonio. You have heard from Don Durrah, who is our real estate professional, and you just listened to James Oliver, who was a tax professional, and he has actually a quite profound grasp of the things that are going on right now. So I'll let you go ahead and ask questions if you have, and then I will ask a few myself.
Yes. Of course, I didn't hear everything. I don't know. I don't want to be too redundant, but some of the things that I want to express and get out to the listening audience with Brother Don, I'm sure he talked about the date that if you had any grievances as far as the tax is concerned, county taxes are concerned, you could take it up then. And of course, I want to put a twist when we talk about, because a lot of people want to get into maybe those tax foreclosures and things like that. They need to know that our county deals with a private entity. If I'm not mistaken, Brother Don, you can chime in, that they contracted with them in order to pick up those particular properties. So it may be difficult in this area for us to get into the real estate business doing those county tax foreclosures. I'm right there, Brother Don.
Yes, you can always go down to the sheriff's sale, and that happens before it gets to the county. It's to clear the sheriff's sale. If you want to go down and purchase property at the sheriff's sale, then but you should do a lot of investigation. I manage some property as a condominiums, and in the condominium bylaws it says this property cannot be rented, and homeowners only. And we had several people who purchased properties in that condo thinking that they're going to rent them out. And then they found out after they purchased the property, they can't rent them out. Now they have to try to get rid of the property. So you might have to, before you jump into different things, buying off the sheriff's sale, and you heard the guy bought off the sheriff's sale, made a lot of money, and get somebody to kind of investigate that before you jump into it, because you may be jumping into something that you'll have to pay for it later.
I know, Don, I remember one time we were on the show, and we talked about, I don't know if you did again, talked about people getting some credits as far as their utilities is concerned as well, because this is crunch time and dollars and cents can be tight with everything going up and everybody still claiming COVID issues on why everything is, they're charging so much more for items. But if people trying to penny pinch, they can actually get some rhythm off of their utilities, or getting that type of paying that little extra dollars for insurance if they're homeowners, if they have to do a water line or things like that, or a tank or furnace go out.
Well, there's several places now. One of the places that I use is called Home Serve. And what you do is you sign up for Home Serve, and it covers maybe your electric system, your plumbing system, your heating system, your air condition. Sometimes they have the roof and gutters involved. And what you could do is you pay so much a month, sometimes $4 or $5 a month, on your light bill or your gas bill or your water bill. One of them will collect this monthly payment. And should your hot water tank go out, you can call the home service. Hey, look, my hot water tank went out. They'll have somebody out there. If you call them in the morning, they'll probably be out there that afternoon and fix your hot water tank. So that's a good system. But they have several places that are popping up now that will cover your home expenses in case you have a water line or sewer line, or I've had sewer lines that I've had fixed. I've had hot water tanks. I've had furnaces to fix, all on this, and I pay so much with my gas bill every month.
Wow. Real quick, directed at Brother James. I know you probably, I see you included the business thing a little bit. I always had a philosophy back in the day of this country is based around and is more beneficial to the business owner than the wage earner. Some people deals with things and, with dealing with estates, putting maybe leasing cars instead of actually purchasing cars. I always on the notion of, becoming LLC, finding something to do with the LLC, because I remember when it first came up, it was developed as a little hybrid where it had, you had the best of both worlds, where you had the liability coverage, but then you still had, the self-employment type of coverage where you had tax pass-through status, to where some of your business stuff can be written off of some of your personal stuff. If I'm, correct me if I'm wrong, James, in reference to that, but in dealing with business and economics these days, as far as our people is concerned, we tend not to know some of the better approaches in dealing with income finances and stuff like that. So, and what is available for us to work in our favor. So I don't know if you went over any of those particular tips. And is it a good thing if you have a good business idea to deal with it and becoming a LLC, and when you start dealing with purchasing car versus leasing the car and all that, what are some of the factors that you need to consider if you're thinking that way?
Okay, one of the things, and you're absolutely right, the in terms of being favorable for taxes, is definitely for the person who's the small business owner, the entrepreneur, the person who has I said a kind of a hobby. In 2018, at that time, of course, Donald Trump was the president. He passed something called the Tax Cuts and Jobs Act. And so, and of course, he said that he was for the small business person and he's for the little guy. One thing that was absolutely for sure, he eliminated and snubbed the nose of employees. When the Tax Cuts and Jobs Act was enacted at that time, people who, let's say, for an example, if you worked for a company and you worked out of your home, you could have a home office expense and you could write that off. After the enacted started in 2018, no longer. If, let's say, for an example, you're a teacher, you could write off your, or police officer, you could write off your union dues. No longer. You could not write off union dues as an employee. You could not write off anything that was, let's say, for an example, I'm a car auto repair worker. I work at Toyota, and of course, their repair people, Toyota does not provide their tools. They have to provide their own tools for their toolbox. Prior to 2018, you could write off your tools, your education, if you've had any dues, and once again, as an employee, starting in 2018, that was no longer deductible. Now, there's a small glimmer of hope, maybe a little light at the end of the tunnel, when Mr. Trump had put this in effect. He put it in for 8 years, and so because he thought he was going to be in office for 8 years, and obviously he did not anticipate him not being in the office. And so, starting in 2025, if Congress does absolutely nothing, then there will be some benefits that will come back. It's called a sunsetting, that employees will have some deductions. I actually thought during the COVID time, because a lot of people were home, working out of their home as opposed to working in the office, that Congress would have made some provisions for those employees that were working from their home and bring back the home office expense. They saw fit not to do that. And so people who were working from home could not write off their expenses from home, their home office. The suggestion that I suggested to those employees that were doing that is to see if you get reimbursed from your employer for your home office, because once again, you couldn't write off on your taxes. So, but you are absolutely right. The deductions and the tax write-offs are for the self-employed person, are for the small business person, they are for the entrepreneur. They're not for the employees.
Yeah, that's seem like the small working man. I mean, the guy that punched the clock always gets the short end of the stick. Seem like, and I think we as a people needs to understand that from a business perspective. We can't always be on the tail end of finance, because that seems to be the one thing that keeps us trapped.
But what you can do, let's say, if you got a hobby or something that you like to do, let's say you like to cook and you like to do desserts, well, start a little small business. Make desserts for a restaurant. If you like, there's something that you like to do, let's say you like to tinker a little bit around the house and fix up stuff, then hold yourself as a handyman, and so now you can write off some of these things that you couldn't write off before. And so I would suggest, if you have that, once again, the tax laws definitely favor the small business owner. And so if you have a little side hustle, then you can now write off things that you couldn't write off before that you're still paying taxes on. And so, go ahead.
Yeah, and that's the great thing, and I think that's the hybrid with the LLC is that, and correct me if I'm wrong, James, is that by you establishing that LLC, and then maybe and you're still working,
Mm-hmm.
If you had some losses with the LLC, it can reduce your tax base from your other regular personal job. If you,
Absolutely, absolutely. But now let me just say this though: when people get LLCs, here's the primary reason why you should get an LLC because you can be self-employed and not have an LLC, or you can be self-employed and have an LLC. The primary reason for an LLC, limited liability corporation, it is a asset protection strategy. So what happens is this, is that you want to separate your business assets from your personal assets. So in the event that you get sued, someone can't go after your personal assets. That's the primary reason for your LLC. So if you're in business, um, that way your business assets are separate from your personal assets. And so that's the, like I said, the main reason. Now, as an LLC, how we account for that tax wise or accounting wise. Well, an LLC can be a sole proprietor or a disregarded entity. An LLC can be a partnership with, of course, with one or two more people. An LLC can be an S corp. An LLC can be a C corp. So an LLC can be one of four different entities. But once again, the primary reason for an LLC is to protect your personal assets with your business assets. And so it's good to have. That's something that an attorney should do. And so once again, you have to evaluate what kind of business are you in. Is a possibility that, if I was in the business of making football helmets for kids, I for sure would want this LLC, because if some kid gets concussion from using my helmet, I don't want their parents to be suing me personally for the helmet. On the other hand, if I am, let's say, trading in the stock market and I have an LLC, well, what's the liability of me getting sued doing trading in the stock market? Very, very, very little. So, I said, but the LLC can be very beneficial. But once again, that's hopefully the primary reason for doing that. And the accounting side of the LLC is something different than the structure of the LLC itself.
all right, V.
All right. So I got a question for James, but I also wanted to ask Donald before we end the broadcast about selling homes, because he indicated at the top of our broadcast that he's in the selling business. So I'm going to ask the question of Donald after I ask James this question about cryptocurrency and the taxation of it. As I understand it, what you earn from cryptocurrency is taxed at the capital gains rate and not at the personal income rate. Could you give us some clarity on that?
Yes, actually, that's partially true. Cryptocurrency can be treated almost like stock. And so if you hold the cryptocurrency for more than 12 months and then you sell it, then you will be taxed at the capital gains rate. But if you hold it for less than 12 months, then it's considered just an ordinary gain. And so you're taxed at your regular tax rate. But that's probably the best way to look at cryptocurrency. If you're in the market of, buying cryptocurrency and then they turn around and selling it, then the question is a holding period of time. So if you hold it more than 12 months, you get a capital gains or favorable rate. If you hold it less than 12 months, then you just get ordinary gain. An ordinary tax.
Okay. All right. Good to know. Mr. Durrah,
Yes.
those who are interested in selling a home probably need to do some things to maximize what they can get from the sale of the home. We want to give them some guidance on things that they should keep in mind if they decide that they want to give up their abode.
Okay. Now, there's several ways you can do this. You can sell the home as is, and you don't have to do a thing to it. But the price is going to be much lower than market. You have to determine to yourself, within yourself, if I put 10,000 in this property, am I just going to get 10,000 back, or do I gain 20,000 by putting 10,000 in? So your house must be safe, sound, and sanitary. It must have free of all violations. First of all, now people walk around and they need, most of the people who buy need financing. They're going to have the house appraised. they're going to want to have a home inspection. So the house has to be in pretty good shape. Uh, then your house is ready for sale. You can have someone come through. You can have an appraiser come through prior to you putting it on the market and letting you know what you can get for that home. That would be the best thing for people who are not on the market trading back and forth on a regular basis. Have someone come in and say, look, your house is worth this amount of money, but you got to get that furnace fixed. I hear that furnace roaring. You got to get that fixed. Or you got to get those 3 broken windows you get those steps out front fixed. Or you got to paint this house before. So now you know what you have to do in order to get the top dollar for that house.
Okay. Give us an idea of what it would cost to get an appraisal done.
Most appraisals run for a single family from 400 to 500, and for a 2 to 4 family, a 2 to 4 family is pretty much the same. It could be 600 to 800. And if you have a business, it depends on it. They usually start about 2,000 for apartment buildings like 6, 8, 10 suiters, and it can go from there.
Okay. Want to open up and ask James about what he does, because you can go to H&R Block and some of the other tax preparers. What are the advantages to going with JC and Associates versus going with some of those others? What types of rates do you have?
Well, one of the biggest advantages is that I am what's called an enrolled agent. An enrolled agent is someone who has been certified by the Internal Revenue Service to prepare taxes. H&R Block, unfortunately, and I don't want to speak on, and it probably shouldn't even said H&R Block, but those big boxes, a lot of times are the people who are preparing your taxes are people who are working there part-time. And so they're just doing this as a side hustle for themselves or a little extra income, and they may not be one as knowledgeable on with respect to the taxes. A lot of times I've actually had someone call me just the other day who said that they had the return done by someone from H&R, and they had a problem, and they went back to H&R, and that person was no longer there working for them. And the people who were trying to help this person didn't know exactly what that person had done. And so with me, I stand behind all my work. The other biggest things that a lot of preparers don't do, like the Jackson Hughes, is that tax planning. The best way you get the biggest bang for your dollar is the tax planning. And tax planning is not just bring your taxes at April 15th and say, what can I do? Tax planning this next month is January. If you want to save the most in your taxes for next year, tax planning starts January 1st and goes throughout the whole year. I can sit down as a tax strategist with you and say, hey, here's some of the things that you need to do to lower your taxes. Okay, besides just giving you a tax return, this is what you owe, this is what your refund. We can develop strategies to help you. Like, for an example, as Antonio said, hey, one thing you could do is start your own business. What do you like to do to have a side hustle, turn that into a side business? Or hey, maybe talk to Don because you might have rental property. Rental property is also another way to have a write-off. It's rental property is nice because it can do 2 things. It can bring you income, and as well, it can be a nice write-off. And so those are things that I do that other people don't do, is to strategize with you to help you bring your taxes. Another thing that I also do besides this taxes, I help people to reduce their debt, to get out of debt. I help people to try to maximize their retirement. And so those are things that I look to help people with in terms of retirement planning, tax planning, financial planning, as well as tax preparation.
Okay, so we have your number up on the screen. It's 216-491-9350. Again, it's 216-491-9350. And the web address is www.cleveland-accounting.com. We're going to post this to Facebook and YouTube. So if you didn't write it down, there will be another place for you to get it. Quickly, we'll go to Donald and ask Donald, how can folks reach you if they're interested in taking advantages of what you do?
Okay, I see you have the number at the bottom, 216-701-5300. 888-878-5319. That is my cell, so you'll come straight to me. And if it does go to voicemail, that means I'm just on the phone talking to someone else. But I'll call you right back. Leave a message and I'll call you right back as soon as I get off the phone. I see your number coming in, but I just can't tear away at that moment. And I'll call you right back.
Okay. Sorry about that, James. I had you on the screen when Donna was talking. I was distracted there slightly. I wanted, yes.
Let me say this. If you think you are being overtaxed, give me a call. I'll run a preliminary and see if you have a fighting chance. I don't want to take just anybody just to fight. If you don't have a fighting chance, I'll tell you right off.
Okay.
You know.
Good to know. Good to know. So with that, I'd like to thank Don Durrah and James Oliver for joining us on the program. You have their numbers and you have a way to contact them. If you have some ideas that perhaps you're being taxed too much on your house, you can file that appeal, and you've got a few months to get that done. And if you want to have some real good ammunition, give Donald a call and he'll see whether or not you have a fighting chance.
And I'm going to call James right after this program because I want to talk to him.
Okay.
All right. Glad we could make that happen for you. Just as a note to everyone, make sure that you check the schedule on the Greater Cleveland Kwanzaa Alliance for the Kwanzaas that are coming up in the coming week. We have just a few moments. I'm glad that Brother Hamptonio was able to join us on the show today. As always, he brings great value to the conversation. Thank you to our engineer, Tone Harley, for making all of this possible. We appreciate you so much, brother. And I hope you enjoyed your day off last week. And as always, know yourself, love yourself, be yourself, make today your best day. Peace.
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 Thank you, guys.
Okay.
All right.
All right.
Peace.